do this. There we go. So we're going to record this and make it available to anybody that couldn't make it this morning. Got another person to admit. Give me 1 second. Okay. Okay. All righty. Well, welcome everybody, and welcome to Tuesday at 8 o'clock in Phoenix. It's wherever time it is where you guys. Philip and I think we're in the same time zone. I think everybody else is different. But in about a couple of months, then Philip and I will even be an hour apart. So, anyway, thank you again for joining us and for taking an hour out of your day to learn about life insurance. And this session, kind of by uh, popular demand, is going to be a little bit about using the resources that are available to us and underwriting, and also then talk about IULs, index universal life policies, and how they fit into our bag of tricks. And so, with that, we'll get started. I'm Scott Taubman. I am in Phoenix, Arizona. I am direct to Davion Clark, and upwardsly Ian Graham, trailed us including Jimmy Spildenner, Brian Delaney, and Edward Pritchett. So, as you guys, some of you are new here, we generally, when we meet new people, explain to them who we are upline or downline to, just so that they understand where we fit in within the hierarchy. And as I've told a lot of people over the year and a half since I have been here, I uh, hierarchies are not a position of authority or of more power or anything else. It is just a way to describe who got here before who. And everybody here is an equal. Everybody here has the same opportunity. And so going through what we're doing today, uh, excuse me 1 second. I people, let's see here, admit, there we go. Okay. Um, the Going through how different products that we provide work and how they benefit your clients will only make you better um, at doing your job and explaining how it all works. So this is again index universal life underwriting and the various resources that we have. What we're going to do is we're going to simplify and take the mystery out of IULs. So when you hear me talk about IULs, I'm referring to index universal life. The underwriting process is hypercritical to what we do. The most of the products and the policies that we offer accelerated underwriting, which doesn't always mean immediate decision, but it does mean that more than likely we can skip doing labs and the paramed exam that back in the dark ages when I first got in the business is how everything went. Uh, some of you may have heard me describe in the past that, first of all, I've been in the business about 30 years, so long before even the internet became commonplace in for use in business. And I had a car, and in the trunk of that car were boxes of paper applications from every carrier that we represented. And I'd go and visit clients, most often in their kitchens, and um, write uh, policies on paper, having to be signed. If you guys are uh, familiar with how an application looks, if you don't look at it, it has to be signed in multiple places. And invariably, we'd miss a signature, have to go back and get it re-signed, and then submit it. And that was kind of the way the business worked. And underwriting was fully underwritten. Everybody was fully underwritten, no matter what their health condition was, which meant that somebody had to come out, draw blood, do a urine sample, if they're of a certain age, do an EKG, and then the MIB, which we now know to be done almost instantly when we are um, uh, writing applications took upwards of a week or two to get an answer from. And then the underwriter had to review everything that came from the lab, which would, or from the exam company. Exam One and APPS apps is another one that we use commonly here if we have to do fully underwriting, fully underwritten business. And then any questions came up, the underwriter had to call you or email you or send you a letter. Those of you that know what stamps are, that's how they got to us. And the um, the reality was it took upwards of a month to write an application, and that was the norm. And then it took you another month to get paid. So it was a long process. Now, through the miracle of technology and internet and uh, connectivity between different parties, we can do this most of the time in a matter of anywhere from 15 minutes to an hour in terms of getting a decision and everything else. And that's pretty darn cool. But it has not changed the basic function of an underwriter. Just an underwriter is somebody, or in this case, something, a computer, who um, reviews the information that is provided through the MIB, through the DMV about our prospective client. And the way the computers are set up now, they run an algorithm that says if it meets certain criteria, they're going to approve it. The computer is going to approve it. But the computer is not a human being. It's not going to look at this and reason that maybe this is an issue that isn't an issue, or maybe it's something that we can look at other details in the application and um, understand what this client is all about and still approve it. So as soon as they get something out of the norm, as soon as the computer gets something out of the norm, whether it finds something in the MIB or whether it finds something in DMV or it doesn't like something on the application, it's going to do one of two things. If it hasn't approved it, it's going to do one of two things. It's going to either decline it or it's going to say, we got to talk to a human being. And it's going to refer that case to a live underwriter who's going to review it. Oftentimes, that live underwriter will look at it, understand the parameters, and um, approve it. Sometimes they want more information, sometimes they'll decline it. Now, a decline, I'm just telling you this from personal experience. A decline is not always a decline. You can, I'll give you an example. I got a case right now. Guy is in his mid 50s. He wanted to do debt-free life, so he wrote a whole life contract with Foresters. And when you do a whole life contract using paid up additions and all that kind of stuff, you have to do it fully medically underwritten. Sometimes they'll waive some of it if the person is young enough or if there's nothing that they are suspecting. In this case, they had to run the whole thing because of his age. All his labs turned out normal, but his EKG did not. And I've looked at enough EKGs in my life to know what basically one looks like. This one looked like nothing I'd ever seen before. And I called the client and I said, you know, what went on there with your EKG? And he said the tech told them that the battery was dying and it may give a false reading. Well, he went to Foresters. Foresters declined him because of the EKG. Because frankly, the guy, according to that EKG, the guy probably should have been dead. But obviously he wasn't. And so I went back, talked with the underwriter, talked with the field rep for Foresters, and they are rerunning. In fact, today's the 20th. In 2 days, they're rerunning the EKG because we've all said it wasn't right. I expect it'll come back normal and we'll get this thing approved. But it's taken a long time. This started in the end of June. So we're now towards the end of August. So underwriters are not infallible. They do make mistakes and they can be spoken to and for lack of a better word, negotiated with. But you got to understand what their role is. Their role is to approve things, but their role is also to make sure that they're assigning the appropriate risk to that particular client. And their job is to protect the company, the insurance company, from being too liberal in their risk assessments so that policies are not being priced correctly and ultimately the company would not make money. And as we all know, insurance companies are not in the business to not make money. So they determine what premium should be charged based on the individual characteristics of the client. It's crucial. They're crucial people. They are critical people to the process. And it's the cornerstone of everything that a life insurance policy is all about. As I said earlier, it's gotten much easier because of computers and algorithms that can be built in. But if something's outside of the norm, it is not going to, the computer is not going to approve it. So if you're expecting something, the client, and the client has told you that they're perfectly healthy and they don't take any meds or anything else, and something crops up on the MIB, the computer's going to say, what is this? Sometimes it'll ask you to just during the process of the application to explain what they're using that med for. And as long as it's not for something that is, from a health standpoint, dangerous, uh, it has built into the algorithm the ability to approve it. So the underwriting process, and I think I'm going through a lot of this, it includes medical examinations, risk assessment, or decision making on the based on the gathered information. Any questions about underwriting, what their role is, how to deal with them, anything that anybody want to ask me before we go on to talking about IULs and the IUL process? I can't be that good. I'm sorry. All right. So
Hey,
IULs,
Scott,
index.
Scott, this is Joe. This is
Hey,
Joe
go ahead. Go
Fantozzi. How
ahead,
are you?
Joe. Good, buddy.
Hey,
How are you?
good, good. When you're talking to an underwriter, and you're talking directly about the client, do you have to talk in like hypotheticals, or are you able to talk like I've heard in the past where like if you say something or you say the wrong thing, it can be recorded or written down about the client or something like that. Like say if you have, I don't know, whatever physical ailment, just say, well, just to name one, diabetes, and you talk, and I call up and I say, hey, I have Scott Tubman that's uh, looking for a policy. He wants this, and he has diabetes. Do you have to do it that way, or do you say, I have a client that has diabetes? What does it look like for you guys?
Okay, so what you're talking about is the pre underwriting process where you're trying to get an idea of what to quote, and that's a great way to go about it if you're not sure. And we'll talk about other resources we have here in a minute. But talking to the underwriter, when I generally have that conversation where it's prior to ever submitting the app, I will do exactly the way you described, but not name the client. I say, look, I got a 45-year-old male, height and weight, and they're type 2 diabetic and they're taking this pill. A1C has been around 6.5. And, given that there's no other health conditions and this is their physical, their BMI, what do you think? And I'll get the answer that way. We have other tools that will help us do that. Uh, but nothing is going to be a better substitution than actually talking to the underwriter at a specific company when you're getting ready to write their app. Now, if we're talking to them in, if we're talking to them in real time about a real application that is got some kind of question about it, whether it's been a decline or we need more information or whatever, you remember you got HIPAA issues. And HIPAA issues means that the underwriter is not going to generally give you a lot of information that is specific because they can't. You've not been approved by the client to receive that information. So what you do, and there's lots of ways to get around this, and nothing's nefarious, but you can say, okay, look, I understand that their that we can't disclose exactly what you found, but can you direct me to where on the application the issue is? And they'll tell you, and especially when it has to do with health questionnaires. You go into the health questionnaire and they'll tell you, well, it's in 1A sub paragraph F. And you go look at that and it'll say, okay, there's a question about a medication. It's not going to tell you what medication, they're just going to tell you that. Or I had one just recently where the application said that uh, parent, the parents are alive and well, and one parent wasn't, and we had to go back and correct that. So those are things that you can do in real time. Now, truth be told, if you talk to underwriters enough and you talk to specific underwriters enough, they will be more forthcoming about what's going on. I can talk to certain underwriters that I've gotten to know over the years and say, okay, what's the issue here? And I say, well, they told me they weren't taking anything and they're taking metformin, which is a diabetes drug. That's a big red flag to an insurance company. What's the diabetes? Is it type 1, type 2? What's metformin? It's type 2. But what's the A1C? Do they have any other issues? Any neuropathy? Any of those kind of things that go on with that? And they'll talk to us about that, knowing that what we're trying to do is help the client. And as I said earlier, underwriter's job is not to decline you, it's to approve you, but at the appropriate risk level. And the the they will help you as best they can. And the better and the more frequent and the more relationship you build with this underwriter, the better you're going to be able to deal with things that pop up, especially when the algorithm in the computer kicks it back. So, um, does that answer your question, Joe?
Yeah, 100%. Thank you very
Okay.
much. I appreciate that.
All right. So Index Universal Life. Index Universal Life is one of the three basic kinds of life insurance policies that we here provide to our clients. Term insurance, temporary insurance, non-cash value insurance for a specific period of time. We discussed that last week. If you missed that session, go back and find the replay. It's posted in the group me's, and you can watch it and learn about term insurance. There's whole life, and we'll talk about whole life next week. Whole life is a type of cash value life insurance, but the way it accumulates this cash value is different than the way IULs do. So, by its very definition, IULs, Index Universal Life, is a cash value policy that has a wide range of features and has a lot of flexibility in the way you can construct it based on the needs of the client. And it uses market indexes as the measuring stick about how the money is going to grow. Day one of the policy year starts the crediting period. And whether it's a 1 year or 2 year or a month to month, whatever the strategy is you're using in the indexing, it's going to credit interest to the contract based on that crediting period if markets are positive and the index went up, and it'll go up to the limit that is set in the indexing strategy. Some are capped, some are uncapped. Some have multiples of growth, some are straight, whatever the growth is, that's what you get. But every end of every crediting period, the insurance company is going to credit that percentage that is part of that's the contractual amount. It's going to credit that to the cash value of the contract. In the years where those market indexes do not go up, the client does not lose money. Their value stays the same. And in fact, in most cases, they get a bit of nominal interest that the company provides. Can be anywhere from 1/4% to 1%. It depends on the company. And it's something you got to read in the fine print when you look at the indexing and you look at the index strategies. And the other neat thing about indexes is that in those years where the indexes go down, and I'll give you an example. Let's say on day one, the index is 1,000. And on day 365, it's a 1 year crediting strategy, the index is 900. So the index went down 10%, right? Simple math. Client didn't lose any money. They still got whatever they had to begin with. They got that plus some nominal interest. However, the cool part is, and we'll contrast this to the securities world. The cool part is that the index strategy is reset to the lower amount. So going forward into the next year, their baseline is 900, not 1,000. And the reason that's important, and when you're talking to your client, explain this to them. The reason this is important is because if they had the money in the market, whether it be in stocks, bonds, ETFs, you name the variable investment, they have to make up that 10% before they make any money the next year. Here we don't. Here we get the lower baseline to start with, and we grow in the next year, whatever the growth is, and they get applied to their contract based on the contractual amount that's applied through the index. This is an important feature when people are looking for security and safety, and especially if they're risk averse. Because here they can grow at near or at market rates, depending upon which index it is, but not have the fear of, okay, what happens if the markets tank? And this is really, really a big selling point. And this is true in both life insurance and in annuities. And we'll talk about annuities in a later session, but understand that this is a huge, huge, huge feature. And given what's happened in the market over the last 3 or 4 years with rising interest rates and now increased volatility, there is some safety in doing these kinds of things. Any questions there? Anybody have uh, any question what I was talking about?
Hey Scott, I do have a question. Thank you so much.
Yeah, Roshana.
Does that index reset annually, quarterly, or does it depend on the product?
It depends on the marketing. It depends on the index strategy they choose. Some are reset monthly. There's monthly point to point. There's annual point to point. There's 2 years point to point. It just depends on which one you choose. And what I would recommend you do is either get with your upline or me or a mentor or whatever, or call the company and talk to somebody in new case design and get more information about it. All information is in on the carrier site. It's there. It'll talk to you about how it works. But if you're not familiar with it or you want to know how it works, talk to one of us and we'll be able to talk to you about how it works. But it just depends on the crediting strategy.
Scott.
Okay. All right. When we talked about um, life insurance products, and I know we didn't cover this last week in great detail, so I just want to do it again today. The left side is somebody who is completely risk averse and wants no chance of losing money. The right side is people that have a more aggressive stance and have the ability or the tolerance to have the variability built into their contracts. The difference in the two extremes is generally, generally, not always, but generally, over a time period of 10 years or more, the people on the right are going to make more money because markets go up. And again, and I hesitate to give numbers, but it's historical we used to say 8 to 9%. Now I think the new reality is probably closer to 6 to 8% over a long period of time. But it just has to do with the changing reality of how markets work and computerized trading stuff that is kind of wonky. But it just has changed the dynamic of how we can predict what we think over a long period of time markets will do. So at the very far left, the safest type of investment besides putting under your mattress are CDs and savings accounts and bank accounts because they have FDIC insurance up to 250,000 per individual per account. But then you have traditional fixed life insurance, which means that it's going to get a guaranteed interest rate, and there are products out there, and we have them this credits an interest rate every year. And there's always an interest rate function within the crediting strategies of every policy. Right now, that amount is between 3.5 to 4.5% in that range. That's the crediting strategy. They'll if you chose 100% that strategy, that's what that client would get every year. Then we get into index universal life, the stuff we're talking about today. More risky then is variable life insurance. Variable universal life works very similar to IULs, except it uses, they call them sub accounts. The reality is they're just mutual funds, and they have a great deal of variability to them. And in years that markets go down and years those sub accounts go down, the client loses cash value. So there's a real loss there. Then, of course, we've got mutual funds and individual stocks and bonds and that kind of stuff. So that's the whole spectrum of risk. When we're talking to our clients and we're talking about what we do, we work in this kind of center section of the model in the IUL world and in the whole life world. Whole life and universal and IULs can be used not interchangeably, but in similar situations based on the client's risk. IULs offer tax-free death benefits to their beneficiaries mostly, unless it's used for in business, and then that's a whole different can of worms. Talk to one of your mentors or somebody who knows about it if you got a business case. Tax-deferred accumulation for the cash value. You're not taxed on the growth until you take the money out and actually do something with it. However, you can also never have that money be taxable. The money cannot be taxable if you take the money out in terms of loans against the contract. If you take out as loans, as opposed to straight withdrawals, the client will not have any tax event. Their beneficiaries will get a death benefit based on the death benefit amount less any outstanding loans. So if this is not something they need to plan for like mortgage protection or something like that, sometimes the death benefit is really irrelevant. It's really about the cash value and the accumulation of the cash value. And we use that in savings plans and talking with clients about how to save money, but also still have a life benefit if they need it. It's tax free if they do it the right way. And then there's also living benefits. Used to have real true long-term care contracts built into life insurance, but they've kind of gone by the wayside. Now we're doing this through living benefits through chronic illness, critical illness type of riders, which work very similar to long-term care insurance, but not exactly. And if you understand long-term care policies, first of all, they're going by the way of the dodo bird. The companies are stopping issuing them. And if you can get them, they're extraordinarily expensive. Because what they're doing is they're saying, I'm going to give you 5, 6, 7 years worth of nursing home care or in-home care or a provider who's going to come to your house or whatever it is. We're going to guarantee that money, but you're going to pay a bunch for that in the form of a premium. And my wife and I have a long-term care policy we took out 25 years ago. I could not afford it if I had to buy it today. It's just a reality. So we can do that. We can do it now through living benefits in the contract. And living benefits exist in every type of life insurance contract. Not every carrier has them, but if you look carefully, we have carriers on term policies, whole life, and IULs that have living benefits. And sometimes it's a no cost extra. Sometimes the rider has a cost associated to it, anywhere from a half to 1.5% per year. Who is the IULs designed for? Roughly ages for people that are accumulating money 30 to 55. They are going to be high earners because they have to be able to overfund this beyond the death benefit cost. Mortality rates generally are the same regardless of the kind of product. And for a carrier that has all different kinds of policies, IULs, whole life, term, the mortality rate, the cost of covering the fact that if somebody dies is going to be the same across all products. Because mortality rates are mortality rates. It's the cost of insuring that person based on the law of large numbers and the risk. It's going to cost the same. However, if you want to add money to your contract, you got to overpay, you got to overfund. And so that's what we're talking about here. High earners or higher earners, or somebody who has very low expenses and has excess cash value. That's where that comes into play. dual incomes, and people are seeking a tax advantage through the withdrawal process, which is not withdrawal, but taking loans, so that they can use this money tax free. And oftentimes they'll use it in retirement. They'll use it to buy second homes. They'll use it to pay for educations. We talked about this in the past conversation we had about $1 million baby policies. Those kinds of things where you want to accumulate a lot of cash, but you got to pay more than just the base premium. If you're just paying targeted, it's not going to work. You got to go beyond that. And if you're trying to protect somebody, ages 35 to 70, the death benefit that meets their needs, moderate to moderately conservative investors, again, remember, there's no risk here of losing money. And people who have children, others who would depend upon them, again, same idea as mortgage protection. What happens if I'm not here? Who's my family living with 90 days from now? And seeking the tax advantages, may want long-term care type of coverage, and want coverage to last a lifetime and not be time bound like a term policy.
I had a
So,
question.
yes, please.
Yeah, so is 70 the limit on?
It's not the limit, because you can get policies at higher age values. The problem is that the mortality rates start getting cost prohibitive to most people. And the cost of insurance can be very expensive. And frankly, for a 70-year-old or older, I'm going to wonder and ask why they want that death benefit, and would a critical period policy make more sense if they're a protector, if you will, because we can do, again, general rule of thumb, not cast in stone, but general rule of thumb. Somebody who's getting older, their kids are gone generally. Oftentimes it's them by themselves or with a spouse. There's health issues, whatever there is. And what we're really trying to do is protect the equity in the property once that person dies, so that they can make the mortgage payments during that period when they're going to sell the property, and then the family reaps the benefit of the equity in the home when the house is sold. That's, it's not, look, Phil, it's not always the case. There's going to be exceptions, but you got to really understand, can the client afford it? I mean, I'm 69. For me to go out and get an IUL today would probably cost 4 or 5 times what it did when I bought them when I was 25. Maybe even more than that in terms of a multiple, because my health has changed since I was 25. So, Delaney, I saw that. Quit smiling. Um, the the reality is that we got to understand and know your client. You got to really know your client. So the way it works is policyholder makes the payment. A portion of the payment goes to pay the policy fees and charges, what the cost of mortality rate, all that kind of stuff. They also want to make a profit. They're not in the business to lose money, so they're going to tack in some kind of profit margin into the premium. And then the remaining premium, the remaining amount, can be allocated across the index strategies. And depending upon what their goals are, what their time frame is, and that kind of stuff will depend on what strategy you choose. And then there's also the death benefit. There's a need to be, oftentimes when I write an IUL, I'll write it for as low a death benefit as I possibly can, as long as I don't, and we haven't gotten into this yet, and I won't necessarily do it today in detail. We don't want to make this contract taxable or make it a modified endowment contract. And so, or MEC, you'll hear people in the industry talk about MECing the contract. That is bad, because that means that every part of that contract is taxable no matter who gets it. And that's a bad thing, especially if you got a $500,000 policy and they're in a 10% tax bracket. That means 50% is going to taxes. 50, $100,000 contract, and they're in 10% tax bracket, $10,000 are going to taxes. And so they're only getting 90 grand on that contract. However, the software will help you work through not MECing the contract. You can add term riders to it. You can do all kinds of things that will increase the value. MECing a contract means that the cash value generally is more than the death benefit. That's the most simple way to explain it. That cannot be. The IRS frowns on that. So the software will allow you to make the adjustments you need to make. Who are our core IUL carriers? Now there's others, but this is the core. F&G, Foresters, Mutual Omaha, and Americo. Americo is a new entrant to our bag of tricks, and it's an instant approval or instant decision. Let's put that instant decision contract. It has some parameters built around it. It's not nearly as flexible as say F&G is, but for somebody who wants a contract, it's going to last them a lifetime that doesn't necessarily need some of the internal benefits like the cash growth or whatever. Americo is a great solution. F&G is the opposite end of the spectrum. It's got a lot of flexibility in its path setter product built into it, where you can build it all kinds of different ways, meeting the client needs both now from a cash flow standpoint and long term with terms of cash accumulation and death benefit. Foresters, their IUL is very good. Their whole life product is better for what they do, but they do have a whole life. In Mutual Omaha, through the IULE, Index Universal Life Express, very similar to Americo, doesn't have a great deal of flexibility and its limits are lower, but it's something that meets the needs of a lot of clients. So let's talk about a specific client here. We got Cy Young and his wife kind of young. And they're in their 50s. You remember last week we did Sandy Koufax and his wife, and they were in their 30s. Now we got Cy and kinda, and they're in their 50s. So with that comes two things: higher cost of insurance and most likely some health issues. However, what also comes with that is probably they have more money than Sandy and Sandra did last week because they're older, kids may be out of the house, that kind of thing. So I'm going to stop the share here and go to, give me with me 1 second while I do this and open that. And I'm going to go to one of our resources. Normally, in a situation like this, I may go directly to Navigator and run the illustrations, but not with these guys. I got some health issues. So if you remember, and I know you guys are looking at the virtual mentor with, and I'm just going to read off what's on the CQF form. Cy, 51 years old, 6', 220, has high blood pressure, type 2 diabetes, and cholesterol issues. He takes irbesartan for the high blood pressure, takes metformin for the diabetes, and he takes a statin, which is a cholesterol med. So in Virtual Mentor, which you find in HQ under the hamburger on the top, it just says Virtual Mentor. Click on it, you will get this screen. So he's 51, 51. He's weighs 220 pounds. He's 6'0".
You got 5 feet.
Okay, thank you. Okay, so he lives in Arizona. Substances is just tobacco or no tobacco. At some point, we'll talk about marijuana use, but for right now, let's just stick to tobacco stuff. He's on medications. So what medication is on? First thing he's on is irbesartan. Irbesartan is a blood pressure medicine. He does have diabetes. He's not been treated for shock. He was diagnosed when, let's say he was diagnosed at age 18 to 35, or maybe 35 to 40. Is he taking insulin? No. And is it combined with any of the following? Gout, peripheral vascular disease, neuropathy, retinopathy, which is an eye disease? We'll say no. And let's just say that that's it for there. Then we got metformin. And let's say it's the extended release. Same questions. So we don't need to say, we don't need to add anything to that. And then lastly, he's on a statin. Let's just, I don't know if there's a list. Okay, so Oh gosh, somebody name a statin drug.
Rosuvastatin.
R-O,
Rosuvastatin. SU.
R-O-S-U. There we go. Thank you. All right. Does he have any other related? He doesn't have any of this stuff. He's an alcoholic. He's not blind. Okay, good deal. All right. So now he doesn't have any of these things. He's not cancer. He is diabetic. We've taken care of that. No digestive issues. We hit search. It will tell us the carriers that will write this guy. Americo, Foresters, UHL, American Amicable, another Americo, Transamerica, Foresters, some more Foresters, UHL. Now, this is not, just so you know, this is not an all-inclusive list. So you want to go look at specific carriers. You can look here, and then once I'm here and I understand the carriers, one of the things that I do immediately is I go to SFG quotes. Actually, I actually have this on my desktop, and I look at the underwriting cheat sheet. Can you guys see that now? Underwriting cheat sheet. Can you everybody see that? Okay, thank you, Dee.
Yep.
Okay.
Yes.
Yes, and I apologize because I've got this on my main screen and I can't see you guys real well. So thank you. All right, so make this a little bit smaller. Okay. Let's just explore this, understand how it works, but down towards the bottom are the medical conditions. And the biggest one we're concerned about here is diabetes. High blood pressure and cholesterol, while they're important, are not the critical issues here. So you're going to have diabetes. I normally just go like this, so I highlighted the whole section. It's just a spreadsheet. Will go across the board and tell me every carrier that will accept it and the type of policy, express term, a little more careful. Then you've got uh, American Eagle whole life, which is a final expense policy. They'll accept it. And you just work your way across all the carriers. You know, here's one in green. It's John Hancock's Vitality contract. You know, oftentimes when we have diabetics we're dealing with, we're going to talk to Foresters, we're going to talk to Mutual Omaha, talk to United Home Life. And here's even UHL in their simple term. They'll take somebody on insulin, which is generally used for a type 1 diabetic, but not always. So two places you're going to go look. Virtual Mentor, find that in HQ under the hamburger. And this cheat sheet is found in sfgquotes.com. Scroll down about 2/3 of the way down the page, and this will be there. To the left of it, let me show you. To the left of it is another important cheat sheet. This cheat sheet will tell you which carriers do what and what the parameters are. So here's a simple issue term, non-medical. So accelerated underwriting. Here's the different carriers. AmAm will do express term up to 75 for up to 500 grand. And you can convert it to an IUL or a whole life up to age 75. It'll also do the same thing for final expense. Here's final expense, which will include both simplified issue underwriting and guaranteed issue underwriting. Here's like AIG, Corebridge, GIWL, guaranteed issue whole life, SIWL, simplified issue whole life. This one I've written for people that are stage 4 cancer and they died within a year. Simplified issue is still pretty liberal, but it's not guaranteed. So when you apply, what'll happen is on the system in Corebridge's site, they'll tell you not eligible for SIWL, but they're eligible for GIWL, and they'll give you the rates. Then you've got accident products, all our accident, some of our accident care. Here's IULs, what we're talking about today. So these two charts here, I go to these all the time. And it helps me with my underwriting. But then if I have questions, I go to where? I go to the underwriter. I go to the carrier and have a conversation. But I've got direction at that point on how to, how to do this. So let's now look at my buddy Cy. Go here, and then I'm going to go to here. So in clients, maybe, gotta log me in. I got Cy and Kinda. In Navigator, now what I'm going to do is I'm going to do the same thing I just did. I want to quote. I put the demographics in already. Arizona, base amount, let's say 350,000, and let's say a 20-year term. Okay. Eventually, we're going to be able to do IULs in here. Right now, probably coming in the next, I'm guessing, 2 to 3 months. I think there's going to be a significant announcement. And Brian, maybe you know more. Once we get the conference from the carriers, they're going to do this.
Yep,
So I'm just putting it.
there's a
Go
number
ahead.
there's a number of things that are rolling out that are just continuing to make this stronger, Scott. So it's a
Yeah.
great time to be introducing this.
Absolutely. So we got this in there. He's a U.S. resident. He doesn't smoke, doesn't use drugs or pot anyway. He's diabetic, type 2. He was, let's call him 40 when he got diagnosed. A1C, if you don't know what A1C is, let me know. I'll have to explain it to you. The lower, the better. So let's just say it's well controlled. For a diabetic, under 6.5 is considered well controlled. They don't take insulin. And then they do have high blood pressure. And you need to ask these questions. So let's just call this, I'm sorry, call this guy normal. And he takes 1 med, irbesartan. All right. Again, you want to go over this stuff with them and don't guess. Make sure you ask the questions. Say both his parents lived healthy lives. He's not a risk on the road, unlike some of the drivers around here. And it'll tell us who will write this person. Again, generally, not every carrier is on here. That's why I'm going to go back to the cheat sheets and look. So American Amicable will write a 20-year term at a standard no tobacco rating for about $241 a month.
Hey, Scott,
Yes,
can I
sir.
mention something here?
Yeah, absolutely.
So a lot of people, when they go through this, they forget that everything we use is a sales tool, because these are resources that these people are getting access to that without us, they wouldn't have access to. And so they're being put into a filter that's taking a look at what the best thing is for them based on their age, based on their health. And then we get to start thinking and shaping the situation. But given that, it's looking at how we can get them the most insurance possible. And so as we go through this, a lot of times we'll skip questions, which is not a good thing to do. It actually worsens your posture. Imagine going to the doctor who asks the fewest questions. You'd have the least amount of trust, right? And so we understand that dynamic. Here's the one thing that I do is after I go through this, Scott, I let them know. I'm like, I'll say to Cy, if I was on the phone with them, I would say, hey, Cy, I've got great news. It looks like you're a 5-star fit for one of our top choice companies. And that's fantastic news. We still have to go through the qualifying piece of this, but initially it's looking really good for you. Okay. We're telling them that they're a 5-star fit for a company. You know what most people's experience is with life insurance? Most people's experience with life insurance is they're underquoted in order to get the business. They're put through underwriting. Their underwriting comes out different 75% of all fully underwritten policies, which is the majority. A lot of people who are in the life insurance business, like your average State Farms, are putting them completely fully underwritten. 70% of all fully underwritten policies in the marketplace go approved other than as applied for or declined.
Right.
So over 70% of the time, the client is having an overridingly negative experience with this that makes them hand and hot stove to go back. What you can show is a level of professionalism that exceeds your level of experience, because you get the leverage tools that were built not only with the psychology, but with the practices of a collective experience of multiple centuries in this business, right?
Yeah, for
Different
sure.
experiences. And each one of us has the opportunity to stand on the shoulders of the work that's been done in order to stand tall for our clients. I just wanted to mention that because sometimes we forget to talk about it. It's like, hey, Scott, great news. Based on that underwriting, it looks like on the front end you're a 5-star fit. We still have to do some underwriting pieces here and select what level you want to be at, but it's fantastic news. So I just want to let you know that.
Yeah.
And
And what I
that's
what
just
I
the
add,
simple.
and when I'm saying, much along the same lines as what Brian just described, I will say based on the information you provided me, because I'm not going to say they lie, but they leave things out, and we get caught unaware when we're talking to the insurance company. So when you say based on the information you provided me, here's where you fit, but that's going to be confirmed by the insurance company, by the carrier, when they do the full underwriting process that we'll do through the application. Some people will think I still can beat the system. Some people will think, okay, I better disclose whatever it is. So here in Navigator, you've got AMAM at 240 and 66 cents, Banner / LNG, they'll do it at 256, SBLI 260, Foresters at 266. And then the other one that's in our system is Mutual of Omaha, and it's not available based on the pre-underwriting questions. So the things that we provided in there knocked Moo out. And then if it's a go, in the AMAM one, you click here, it takes you to their application on their site. And the others, in SBLI and Banner, it'll take us directly to the application. And in Forester, same kind of thing. It'll take us, you have to click on it. You click on here, and then you click there to go there, to take you to the application. Play with Navigator. Use everybody in the world you know about to run illustrations and quotes so you understand how this works. And then, as we've said frequently, get familiar with the application process. So run applications on your family, your friends, your dog, whoever it is. Run those so that you can get familiar with it. Because the last thing you want to do is be caught unaware or slow things down while you are taking the application with the client. All right, so Cy and I won't go through Conda Young's. It's similar, exactly the same process with her, and then you provide the information. She has arthritis and a heart murmur. Both of those are not deal breakers, but you still got to find the right carrier. We've talked about this, and just keep this in mind. Health history, lifestyle choices. You know, if they go skydive any other weekend, they're probably not going to get a policy. What they would do for work. You know, a lot of carriers won't underwrite either active duty military or people in first responder positions, and their financial status. If the policy death benefit is high enough, they're going to want to know about their financials. That's a phone call. It's not a horrible phone call. I've been through it many times with clients, but they still want to know about their financial situation. So what are the most common reasons why we get messed up in underwriting? Incomplete information, misinformation, or missing information, fraud, changes in health status they didn't disclose, and legal complexities. Somebody who, and I'll call a disability, it's not really a legal complexity, but it's something that insurance companies look at. If they're on disability, they want to know why. And they'll know that through the MIB. It'll tell them. So I alluded to this before. 45% of all policies being issued today are being done through automated underwriting. That means a computer on our end that's got the application is talking to a computer on the other end, and it's running our information through their algorithm to decide whether it's smooth sailing or not. There's changes coming to the way insurance is being written. And when I was at Allstate, last time I was there was 2017. They were coming up with a way to underwrite you without the medical information, using information out there from everything from uh, just running a simple DNA test to seeing the information's out there around your DNA. Again, all this has to be HIPAA authorized. Um, Driving record, that kind of stuff, and not having to go through the whole medical underwriting. And then predictive modeling, that's all part of that. It's all coming. And it's kind of what's letting us get more and more automated in our underwriting process. I know we're a minute over. Um, I'm going to stop there and see who needs what and what questions we have. And that's my contact information. Feel free to pick up the phone, email me, text me. That's my cell phone, so I get text messages. Who has any questions?
I do, Scott.
Yes, sir.
Um, I wrote a policy 3 weeks ago, and it was declined by Occidental because they sent out to doctors and they got some other information. He had an EKG in 2021. He's on propanolol
Okay.
for tremors. He had some kind of fall 25 years ago. When Millman sent back their analysis, there was issues, and it
Yeah,
seems
that
like there
drug
are four.
that drug is often used for oh God, Parkinson's. And
Right, but
so
yeah, he uses it for, he got some kind of neuropathy, and he uses it for that. He went for an EKG in 2021, and Millman sent back to Occidental that there was some issues with that. I'm working with my hopeful customer, and he just sent me all his medicals and stuff, and I'm not a doctor, too much to my grandmother's dismay. But just looking through it, he's been on that medication for 25 years. After this supposed EKG that wasn't great, there was no further medication, nothing else was given. So he's disputing it, and he's going to get in touch with the doctors and see what they could work out. Does this sound like it has any possibility of being good?
yeah, absolutely. But it's going to require direct conversation with the underwriter that's making a decision and go through everything with them and explain it. They're going to probably want more validation, but it's doable. And so,
How do I get to the specific underwriter? Like when I call LGA, I speak to the whoever answers and I get information. How do I know who's actually doing the underwriting?
if so, with respect to Legal and General / Banner, you go to their site, the case itself, you go into that case, it will tell you who the underwriter is.
Great, thank you.
And most carriers have the same thing. Very few of them hide the underwriter. Some do, but most of them don't. And then if you have a real issue and you want to get to it, get a hold of one of your upline. They'll get you to the field rep, and the field rep will then be bird dog it for you.
Terrific, thank you.
Yep. Any other questions? Feel free to reach out to me anytime. I am in right now the Pacific time zone, so I'm going to be up after most of you are. But I'm not going to be up when you guys get up in the morning. So, but
Scott, this
doesn't mean,
Scott, this is Joe. Before, are you going to take any other questions? Because I have one
yeah,
question.
absolutely. Yes, sir. Go ahead.
Hey, so I was looking at an IUL for a client, and because of the amount or the age, it jumped right to $375,000 for the coverage. And I wanted to find something that was much less coverage and more went towards the investment portion of it. It was with F&G. Is
Mhm.
there another company that would do like $100,000 and we could fund it? We're just trying to do like $250 a month. Um,
Yeah.
just wanted to
So
see if
go
you
so,
had.
so go to the cheat sheet,
Yep.
the one that's got the carriers on it. Look at them in terms of their parameters, and then go to their site and look at their specific product and determine whether it's going to fit your client or not. Take some homework. You know, this is not a static environment. It takes digging to find the right product. And as Brian described earlier, we get a whole bunch of carriers listed. Some are more likely and higher rated than others. We want to use them, but you got to look and see what best fits that client. And I'll, you know, the folks that are here, and I mean this to everybody, it was here and had to leave. You got a question, call me, text me,
All right.
email me,
Appreciate it.
and we'll be able to go through what is available to you. And I'll show you and I'll demonstrate. We'll do a Zoom call and I'll demonstrate to you how to go through the carrier site to find out what you're looking for. There's a lot of crap out there. There's a lot of stuff that is um information you need and there's information you don't need. And sorting through it all can be daunting. And my goal is to hopefully shortcut your learning curve so you're more productive as quickly as possible. And so I'm happy to show you how to go through this stuff.
Appreciate that.
Yep.
I had a quick comment. So it looks like this is why you want to use an SME, because it seems rather complex in figuring out all the different, like you said, depends on what you're trying to do. And yeah, it just seems a little complex for someone who's just starting out doing it.
I would agree.
Yeah.
And there's a lot of talk and Brian's not on the meeting anymore. He had to run, but he and I have had a couple of conversations about agents who come in who've never done this before and what their learning curve is like and how it can seem overwhelming and that overwhelmingness can paralyze you in terms of doing stuff on behalf of your client. You don't have to do that. What you have to do is understand what your client's looking for. That's it. That's the extent of it. And I say what they're looking for is what they're trying to solve, not the product solution, but what they're trying to solve in their life. Mortgage protection, saving for a kid, saving for retirement, whatever you name the thought process, whatever that is, the SME will help you and them work through the proper solution. I'm a
Right.
firm believer that not everybody should be an SME until they've done this for a number of years
Mhm.
because you can do more damage than good sometimes, especially around taxes and what the product will really do in the long run, and those kind of things. And you'll learn because the SME will always conclude you as they're your client. They're not the SME's client. They're your client. The SME will bring you along every step of the way, explain to you what they're doing and why they're doing it. And that's a learning curve for you that can be accelerated.
Great. Thank you so much for doing all this.
Oh, it's my pleasure. Next week, we'll do whole life. Talk a bit more about underwriting if it comes up or something else that I can think of between now and then, but there's a lot of things in here that go on. And then even though this is supposed to be a life insurance seminar series, I think I'm going to add annuities into it as well, which get really complex. And the SME process is even more important. But to your point, Phil, if it's beyond your comfort zone, and your comfort zone is determined by you as to what do I really know here and what I don't really know. If it's beyond your knowledge, but you have a client you care about and you want to do something for them, engage in SME. Do that.
Great.
Okay.
Okay.
All right, boys and girls. Thank you so much. My email, my text messaging, my phone, even if you're not part of my team, let me know. We'll talk.
Thank you,
We'll
Scott.
figure out what to.
Thank you,
Okay,
Scott.
Katie, thank
Appreciate
you.
Thank you,
Roshana, thank
thank you.
you. You all take care.